Banking crises are never accidents, and they never strike the United States in a uniform or fair way. Every time history repeats itself, the pattern is disturbingly consistent. The first explosion does not happen everywhere. It erupts at a few very specific points on the financial map. These are places where local economies have weakened from within, where credit has been stretched too far, and where risk has quietly accumulated for years under the illusion of stability. All it takes is a small shock, an interest rate reversal, a sudden drying up of liquidity, a sharp decline in asset values, and the entire fragile structure collapses in a domino effect. American financial history has never hidden this rule. From the past to the present, crises always ignite in the most vulnerable hotspots before spreading outward to the rest of the system. And the crisis unfolding today, even though it wears a different face, is following the same old path. From the perspective of a long-term observer, someone who understands how markets reveal their weaknesses over time, this logic mirrors the thinking that has guided Warren Buffett for decades of investing. Banking crises do not erupt at random. In the entire history of United States finance, no crisis has ever struck the whole system at once. They always begin in specific geographic hotspots where economic conditions are most fragile, where credit concentration is highest, and where the dominoes have been stacked too high and too precariously. In the 1980s, that hotspot was Texas, when collapsing oil prices triggered a chain reaction through real estate and local banks. In 2008, history repeated itself in cities like Phoenix, Las Vegas, and Miami, where the housing bubble had inflated the most and burst the fastest. The current crisis, the one that erased Silicon Valley Bank, Signature Bank, and First Republic from the financial map, and quietly pushed dozens of other institutions onto regulatory watch lists, is no exception. The key difference this time is that the epicenter has shifted. The shock is no longer centered on residential housing, but has moved decisively into commercial real estate. Some cities are absorbing far more damage than the rest of the country. In these places, office vacancy rates have reached historic extremes. Property values have fallen so rapidly that loans originated less than 3 years ago are now deeply distressed. It is in cities like these that bank failures tend to appear first, not because of sudden mismanagement, but because the local economic foundation has been cracking from the inside. That is why, before naming any specific city, it is essential to understand the structural link between geography and banking failure. Banks do not exist as abstract entities floating in financial space. They are rooted in specific locations. They serve specific communities. They lend against tangible assets in very specific markets. A bank headquartered in San Francisco inevitably carries heavy exposure to San Francisco commercial real estate. A bank serving the Dallas metro area concentrates risk in Texas office buildings and retail centers. This geographic concentration becomes a fatal weakness. When the local market turns, nationwide banks can absorb losses in one region because strength elsewhere offsets the damage. Regional banks do not have that luxury, and when their core market collapses, there is nowhere to hide. This pattern defined the savings and loan crisis when Texas banks failed in waves due to shared exposure to oil and real estate. It repeated in 2008 when banks concentrated in Arizona, Nevada, and Florida collapsed at rates far above the national average. And now early warning signs suggest the same script is returning, this time centered on the weakest commercial real estate markets in the United States. This crisis is not evenly distributed. Some cities have been devastated, while others remain largely untouched. That divergence is driven by three key factors. The first is remote work adoption. Cities dominated by technology firms and professional services experienced the strongest shift toward remote and hybrid work. Office buildings emptied as companies realized employees could perform just as well from home while saving millions in rent. The second factor is pre-pandemic construction. Cities that built aggressively before 2020 now face severe oversupply. Shiny new buildings are competing for a shrinking pool of tenants, pushing rents and property values down across entire markets. The final factor is economic diversification. Cities dependent on a single industry are far more vulnerable when that industry weakens or embraces remote work. There are no alternative employers to absorb the vacant space, and the stress flows directly into the banking system. When these three forces overlap, 8 cities emerge as the most dangerous pressure points. This is not speculation. These conclusions are grounded in public data, vacancy rates, falling property values, rising loan delinquencies, and concentrated bank exposure. Warren Buffett has studied these patterns for decades. His approach to banks has never been limited to balance sheets alone. He asks deeper questions. Which markets does the bank serve? How concentrated are those markets? Are local economies expanding or contracting? And can real cash flow support the loans already made? His gradual exit from regional bank positions in recent years reflects a cold assessment. Too many institutions are trapped in markets where fundamentals have deteriorated beyond recovery. He is not waiting to see which bank fails next. He is avoiding the entire group because geographic risk has simply become too high. And for anyone following the commercial real estate crisis closely, the first city on the list comes as no surprise. San Francisco has become the textbook example of office market collapse in America. Downtown vacancy rates have exceeded 35%. Property values have fallen by roughly 50 to 60% from their peak in 2019. A signal no cautious investor can afford to ignore. The argument continues from the same quiet but penetrating perspective that Warren Buffett has carried for decades. It is the voice of someone who watches markets long enough to see value erode long before panic appears. Buildings that were sold for hundreds of millions of dollars just 5 years ago are now changing hands for only a fraction of that price. Some are not trading at all because no buyer can be found at any price that makes sense. The technology sector, which once dominated these towers, embraced remote work more aggressively than any other industry. Companies like Twitter, now known as Salesforce and Meta, have dramatically reduced their office footprints. Small startups that once dreamed of prestigious addresses in San Francisco now operate fully remote. What remains is something close to a ghost city in what used to be the most expensive office market in the United States. Banks with heavy exposure to commercial real estate in San Francisco are under severe pressure. First Republic, headquartered in San Francisco and deeply concentrated in the local market, became the first major casualty. It will not be the last. Many regional banks serving the Bay Area hold commercial real estate exposure exceeding 200% of their capital. A large share of that exposure is tied to San Francisco office buildings, now worth half or less of their loan balances. The Texas ratio at these institutions is rising every quarter as more loans turn non-performing. Some banks have already crossed critical thresholds that historically signal failure. Others are approaching those levels at an alarming pace. If you hold deposits at a regional institution with meaningful exposure to San Francisco, the warning is simple. Calculate its Texas ratio immediately and consider whether your money belongs elsewhere. The second city on this list is Los Angeles. Its challenges are different in form but no less dangerous in substance. Los Angeles has the largest office market in the western United States. That market is now undergoing a slow collapse that has erased billions of dollars in property value. Vacancy rates in downtown Los Angeles have climbed above 30%. Unlike San Francisco, where technology led the exodus, Los Angeles faces a broader economic breakdown. The entertainment industry is shrinking. Corporate headquarters are relocating to Texas and other states. Quality of life is deteriorating due to homelessness, crime, and the highest cost of living in the continental United States. Banks concentrated in Southern California, commercial real estate, are holding loans that may never be fully repaid. The collateral backing those loans is losing value every quarter. At the same time, the deposit base funding these institutions is shrinking as wealthy Californians move to lower tax states with more business-friendly environments. Pacific Premier Bank Corp., First Foundation Bank, and several others identified on regulatory watch lists show dangerous concentration in the Los Angeles market. The third city is Chicago. It represents a particularly severe version of the commercial real estate crisis. Downtown Chicago office space had structural problems even before the pandemic, accelerated remote work. The city has been losing corporate headquarters for decades as companies migrated to warmer climates and lower cost states. Boeing, Caterpillar, Citadel, and other major employers have announced departures in recent years. The remaining tenants cannot absorb the massive supply of office space built during more optimistic times. Vacancy rates downtown now exceed 25% and continue to rise. Property values have fallen so far that some buildings are being demolished rather than renovated. In those cases, the land itself is worth more than the structure. Banks serving the Chicago market, especially those exposed to the Central Business District, face losses that will test their capital adequacy. Wintrust Financial and Old Second Bank Corporation are among the Illinois-focused institutions whose concentrated exposure deserves close scrutiny from depositors. The fourth city is Washington District of Columbia. This may surprise those who associate the capital with stability and government employment. Federal workers provide a stable base of office demand, but the commercial real estate market extends far beyond government buildings. Suburban areas in Virginia and Maryland are filled with offices serving government contractors, lobbying firms, law offices, and professional service companies. Many of these employers have permanently adopted hybrid work models. Office demand has fallen by 30 to 50%. The result is a vacancy crisis pushing overall rates above 20% across the metropolitan area. Some suburban submarkets now exceed 30% vacancy. Banks centered in the Washington District of Columbia region, including Atlantic Union Bankshares and Sandy Spring Bank Corporation, hold loan portfolios dominated by commercial real estate that continues to lose value each quarter. Their Texas ratios are rising. Margins are shrinking. Most depositors remain unaware of the geographic concentration, putting their capital at risk. The fifth city is Denver. It has experienced one of the most dramatic boom and bust cycles in modern commercial real estate history. During the 2010s, Denver became a favored destination for corporate relocations. Technology firms, energy companies, and outdoor lifestyle businesses flooded in. Office construction surged to meet projected growth. The pandemic hit Denver especially hard. The same remote-friendly technology companies that fueled the boom were the first to abandon office space. Today, downtown Denver vacancy exceeds 28%. Neighborhoods like Lower Downtown and River North, once promoted as the next Silicon Valley, are now filled with empty buildings and for-lease signs. First Bank, First Western Financial, and other Colorado-focused institutions hold concentrated investments in commercial real estate that have become increasingly dangerous as values decline. Their exposure to Denver in particular creates risks that geographic diversification within Colorado cannot offset. The sixth city in this picture is Portland, Oregon, and from the perspective of a longtime observer, it may represent the most severe deterioration among major American cities over the past 5 years. Portland did not decline because of a single shock. It weakened under the combined weight of multiple negative forces acting at the same time. The aggressive adoption of remote work, prolonged social unrest, rising crime, and a deepening homelessness crisis pushed both businesses and residents to leave at a record pace. This outflow was not temporary. It reflected a deeper shift in how people evaluate quality of life and long-term business viability. The downtown office market in Portland now shows vacancy rates close to 30%. That level alone is enough to undermine any financial model built during more optimistic years. Retail space is under even greater strain. The pedestrian traffic that once supported downtown commerce has largely disappeared. For banks serving the Portland market, this creates an especially difficult environment. The city's problems no longer resemble a normal economic cycle. They look structural in nature and therefore far harder to reverse in the near term. Companies are not waiting for conditions to improve. They are relocating permanently to cities with more stable and business-friendly environments. This means the commercial real estate recovery many banks are hoping for may never arrive. Institutions such as Umpqua Holdings and Columbia Banking System, along with other Pacific Northwest lenders, carry meaningful exposure to the Portland market. That concentration alone raises serious concern. The seventh city is Houston, where the story is shaped not by technology or social instability, but by a profound transformation in the energy sector. For decades, Houston built its commercial real estate market to serve an expanding oil and gas industry. That foundation is now shifting.
As the world moves toward renewable energy, as efficiency improves, and as fossil fuel extraction requires fewer workers, demand for office space in Houston has declined on a permanent basis.
This is not a short-term downturn. Vacancy rates in the energy corridor home to many major energy companies have climbed above 40%. Buildings that were once fully leased when oil traded above $100 per barrel now sit half empty. Companies have consolidated operations, reduced headcount, and adopted remote work for remaining staff. Downtown Houston faces similar pressure. Vacancy rates approach 25%. Landlords are offering unprecedented concessions just to secure tenants.
Banks concentrated in the Houston market, including Cadence Bank and Stellar Bank, along with several smaller institutions, hold commercial real estate portfolios underwritten during far more optimistic conditions.
Those loans assumed continued growth in energy employment and steady appreciation in property values. Both assumptions have proven false. Non-performing loans are rising. Collateral values now fall below the debt they secure. Any recovery in the energy sector will not undo these losses because the changes reshaping the industry are structural rather than cyclical. The eighth and final city on this list is Phoenix. It presents a far more complex picture than surface appearances suggest. It is also a city many analysts have misunderstood. On the outside, Phoenix appears strong. Population growth has been impressive as people relocate from California and the Midwest to escape high costs and harsh winters. The residential housing market has surged. Master planned communities continue to expand across the desert. All of this creates an image of lasting prosperity. Yet beneath the surface, cracks are forming in Phoenix commercial real estate. During the pandemic era boom, the city built far too much office space. Developers assumed corporate relocations would continue indefinitely. That assumption proved wrong. Although Phoenix attracted several notable headquarters, the volume was not enough to absorb the new supply. As a result, vacancy rates have climbed above 22% and continue to rise. Newer, high-quality buildings are now forced to compete on price with older properties that lack the flexibility to adjust further. Banks serving the Phoenix market, including Western Alliance Bank Corporation and Alliance Bank of Arizona, once viewed their concentration as reasonable during growth. As values decline, that same concentration has become a source of risk. The same pattern appears across the broader Sun Belt. Many banks made similar bets on migration and uninterrupted growth. What connects all 8 cities is not simply high vacancy or falling property values. What truly connects them is the presence of regional banks with dangerous concentration in specific geographic markets. Every bank failure requires 2 conditions. First, a loan portfolio deteriorates until losses exceed capital reserves. Second, depositors lose confidence and withdraw funds faster than liquidity can be generated. These 8 cities are where the first condition is now taking shape. Losses from commercial real estate in San Francisco, Los Angeles, Chicago, Washington, D.C., Denver, Portland, Houston, and Phoenix will concentrate in the banks serving those markets. Their Texas ratios will rise. Capital buffers will erode. Historical thresholds that often signal failure will be crossed. When depositors read headlines about collapsing local property markets, they will begin questioning the safety of their banks. As confidence fades, the second condition emerges. The withdrawal waves that destroyed Silicon Valley Bank and First Republic will repeat. They will move from city to city and institution to institution until the crisis runs its course. Warren Buffett understood the geographic dimension of banking risk decades ago. When evaluating banks, he never focused solely on balance sheet ratios. He studied the markets those banks served. He asked whether local economies were diversified or concentrated. He examined whether the industries driving those economies were expanding or contracting. He considered whether they were cyclical or long-term, fragile or resilient. His decision to reduce bank holdings over the past 2 years reflects a clear judgment. Too many institutions lent aggressively into markets now in decline. He did not need to predict which bank would fail first. He understood that geographic concentration would inevitably produce losses. Some of those losses would be fatal. The safest strategy was not to select winners in a structurally damaged industry, but to step aside entirely. That same geographic lens should be applied to personal banking relationships. If you live in one of these 8 cities or bank with an institution heavily exposed to them, you face higher risk than depositors elsewhere. This does not call for panic or immediate withdrawals. It calls for understanding You should know where your bank is concentrated and whether that exposure creates a vulnerability you are unwilling to accept. This information is publicly available. Banks disclose loan portfolios by category and by geography in quarterly regulatory reports. You can see exactly how exposed your institution is to commercial real estate and to specific urban markets. If that exposure is concentrated in the cities discussed here, diversifying deposits across multiple institutions or choosing banks with true nationwide diversification is not extreme. It is a calm and rational defensive choice. The Federal Deposit Insurance Corporation will never send you a letter warning that your bank is about to fail. That silence is not an accident. It is intentional. Regulators understand that even a single early warning signal can trigger a chain reaction of panic, something that can destroy a bank faster than any loss written on its balance sheet. That is why the only way to protect yourself is to do exactly what regulators do, not openly share, analyze for yourself, question for yourself, assess risk on your own, before the market forces you to do it from a position of weakness. At this point, you already know which cities are the most fragile. You understand why geography is not just background noise, but a structural force that determines whether a bank survives or collapses. More importantly, you now have the tools needed to determine whether the bank holding your money sits inside that danger zone. The only remaining question is simple. Will you use this information or will you ignore it and hope someone else protects your money for you? First, clearly identify where your bank is geographically concentrated. Go to its investor relations website, download the most recent quarterly report or the latest annual report. Look for the section that describes the loan portfolio by geographic region. Many banks openly disclose exposure by state or by metropolitan area. If you see heavy concentration in San Francisco, Los Angeles, Chicago, Washington, District of Columbia, Denver, Portland, Houston, or Phoenix, you need to understand that you are dealing with an institution facing above average risk, driven by the ongoing collapse of commercial real estate markets in those exact locations. The next step is to calculate the Texas ratio using the method explained earlier. A bank that is heavily concentrated in these 8 cities and shows a Texas ratio above 50% is flashing a classic warning signal, recognized throughout United States banking history. If that ratio approaches or exceeds 100%, this is no longer a warning. It is a demand for immediate action to protect your deposits. Next, examine the compounding effect of multiple risks acting together. A bank under pressure from commercial real estate exposure, large unrealized bond losses, and accelerating deposit outflows is facing an existential threat. What is most concerning is that many regional banks in the cities already mentioned are suffering from all 3 pressures. At the same time, loans are becoming harder to collect. Bond portfolios are underwater. Depositors are leaving in search of higher yields or safer havens. This exact combination destroyed Silicon Valley Bank in 48 hours. And the same combination is now hanging over dozens of other institutions. The next step is defensive, but critically important. Diversify your deposits. Do not place all of your assets into a single regional bank, especially one tied closely to a declining market. Spread deposits across multiple institutions and across different geographic regions. Within that structure, there should be at least one fortress bank, such as JP Morgan Chase or Bank of America. Institutions with nationwide scale, true diversification, and capital strength, capable of absorbing losses in any single market. In addition, consider complementing bank deposits with instruments that carry no geographic risk. Treasury bills purchased directly through Treasury Direct are obligations of the federal government. They do not depend on the health of any bank, and they are not tied to any local real estate market. In the current environment, they offer competitive yields with zero credit risk. It is no coincidence that Warren Buffett is holding more than $200 billion in treasury bonds. Not because he lacks investment opportunities, but because he understands that during periods of structural instability, capital preservation must come before capital growth. He is watching the same geographic patterns described here, and he is actively avoiding regional banks concentrated in weakening markets. In other words, he is prepared for the failures that lie ahead, while most depositors remain unaware that their bank could be the next headline. You now possess the same category of information that Buffett uses, the 8 cities where bank failures tend to begin. You understand the mechanism that turns geography into financial tinder, and you know how to check whether you are standing inside the risk zone. The only difference between you and Buffett is scale. He is protecting billions of dollars. You are protecting your family future. In terms of importance, there is no difference at all. Wisdom lies in acting early, not reacting late, because once the first domino falls in your city, the safe choices are often already gone.